Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for informational and educational purposes only. The information provided is based on research and data available at the time of recording and should not be considered legal or financial advice. Always consult with a qualified professional before making any decisions about your insurance coverage. The average driver in Washington, D.C. pays over $2,600 a year for car insurance. Let that sink in for a second. That's nearly double the national average. It's more than drivers in Los Angeles, more than Chicago, and yes, even more than New York City. You are living and driving in one of the most expensive places for car insurance in the entire country. And the worst part? A huge chunk of that money is likely being wasted on coverage you don't need, or it's evaporating because you don't know about specific discounts you're already entitled to. This isn't just a case of bad luck. It's by design. The insurance game in the district is a different beast entirely. It's a complex maze of local laws, unique risk factors, and aggressive pricing models all built to extract the maximum amount of cash from your wallet. Think about it. You're driving in a 68 square mile area packed with commuters, tourists, diplomats with special plates, and some of the most congested traffic circles in America. Add in the constant road construction, the high rate of vehicle theft, and the sheer number of accidents, and you have a perfect storm for sky-high insurance premiums. But here's the secret the big insurance companies don't want you to know. Their pricing models are not infallible. They can be beaten. You can navigate this system, and you can slash your annual bill by hundreds, or even over $1,000 without sacrificing critical protection. You just need the right playbook. And that is exactly what this guide is going to give you. Over the next several parts, we are going to dismantle DC auto insurance piece by piece. We're going to expose the myths, uncover the hidden discounts, and give you a step-by-step framework to get the absolute best coverage for the lowest possible price. By the time you're done watching, you will know more than 99% of DC drivers about their own insurance. You'll understand exactly what liability, PIP, and uninsured motorist coverage means specifically for a DC resident. You'll know the exact questions to ask an agent to unlock discounts they would never offer you up front. You'll learn the single biggest mistake DC drivers make when filing a claim, a mistake that can cost you thousands. And most importantly, you will have the confidence to shop for insurance not as a confused customer, but as an educated expert in control of your own finances. So let's get started. The foundation of understanding your insurance bill is understanding what you're legally required to have. Every state has minimum liability requirements, but DC's are unique. The law in the District of Columbia says you must carry what's called 25/50/10 coverage. This is insurance jargon, but it's simple once you break it down. The first number, 25, stands for $25,000. This is the maximum amount your insurance company will pay for bodily injury to a single person in an accident that you cause. If you hit a pedestrian and they rack up $50,000 in medical bills, your insurance pays the first $25,000, and you are personally on the hook for the other $25,000. They can sue you, garnish your wages, and put a lien on your property to get that money. The second number, 50, stands for $50,000. This is the maximum amount your insurance will pay for total bodily injuries for all people in a single accident you cause. So, if you cause a multi-car pileup and 3 people are injured, your policy will only pay out a grand total of $50,000 to be split among all of them for their medical bills, no matter how high their costs actually are. Again, anything above that, and they're coming after you personally. The final number, 10, stands for $10,000. This is the maximum your policy will pay for property damage you cause in an accident. This covers the other person's car, or maybe a fence you hit, or a light pole. Now, think about the cars you see driving around DC every day. Teslas, BMWs, brand new SUVs. How many of them cost less than $10,000? Almost none. If you so much as tap the bumper of a new Mercedes on Connecticut Avenue and it needs a new sensor array, that repair bill could easily top $10,000. Your state minimum policy pays the 10 grand, and you're getting a bill for the rest. So let's be crystal clear. The legally required minimum insurance in Washington, D.C. is a financial trap. It's designed to keep you legal, not to keep you safe. Driving with only 25/50/10 coverage in a city as expensive and litigious as DC is like walking a tightrope without a net. It's a massive, unnecessary risk to your entire financial future. One bad day, one moment of distraction in DuPont Circle, and you could be facing a lawsuit that wipes out your savings and follows you for years. So what's the solution? The first step to saving money is actually spending a little more in the right place. We recommend, at a bare minimum, increasing your liability limits to 100/300/50. That's 100,000 for a single person's injuries, 300,000 total for all injuries in an accident, and 50,000 for property damage. The jump in protection this provides is monumental. But here's the kicker, the part the insurance companies don't advertise. The cost to make this jump is usually shockingly small. Because the biggest risk to the insurance company is that first dollar of coverage, the price difference between a weak state minimum policy and a strong protective policy might only be $10 or $15 a month. For the price of a few cups of coffee, you buy yourself hundreds of thousands of dollars in financial armor. It is the single best return on investment you can make in your auto insurance policy. Before you do anything else, before you look for any other discounts, you need to check your liability limits. If you have 25/50/10, your number one priority is to call your agent and raise it. But liability is only one piece of the puzzle. DC law also has two other mandatory coverages that are critically important: uninsured motorist coverage and personal injury protection. And this is where things get really interesting, because how you handle these can save you a fortune or cost you dearly. Uninsured motorist coverage, or UM, is exactly what it sounds like. It protects you if you are hit by a driver who has no insurance at all. And in DC, the estimates of uninsured drivers on the road are as high as 15%. That's more than 1 in every 7 cars around you. This coverage also protects you in a hit and run, which is incredibly common in the city's tight streets and chaotic parking garages. DC requires you to have UM coverage that matches your bodily injury liability limits. So at a minimum, that's 25/50. This coverage pays for your medical bills and lost wages if an uninsured driver injures you. There's also uninsured motorist property damage, which is optional, but it's a cheap way to protect yourself if an uninsured driver totals your car and you don't have collision coverage. Now let's talk about the big one, the most misunderstood part of DC auto insurance: personal injury protection, or PIP. DC is what's known as a no-fault jurisdiction, which is a bit of a misnomer. What it really means is that if you are injured in an accident, regardless of who was at fault, your own insurance company is the first in line to pay for your medical expenses and lost wages, up to your PIP limit. The mandatory minimum PIP coverage in DC is $50,000. This is designed to get you medical care quickly without having to wait for a long, drawn-out legal battle to determine who is at fault. Your PIP coverage pays your doctors directly and immediately. It's fantastic protection to have. But here's the crucial DC twist: when you are in an accident, you have a choice to make. You have 60 days to decide whether to accept your PIP benefits or to sue the at-fault driver for your pain and suffering and medical costs. You cannot do both. If you take the PIP money, you give up your right to sue the other driver for your injuries, unless those injuries are catastrophic, leading to permanent scarring, disfigurement, or an impairment that lasts more than 180 days. This is a massive decision to make, and it's a decision most DC drivers have no idea they even have. Understanding this choice is fundamental to protecting yourself after an accident in the district. In the upcoming parts of this guide, we will walk you through exactly how to make that choice. But for now, the key takeaway is this: your mandatory PIP coverage is your first line of defense for your own health, and you need to understand the trade-offs that come with using it. Now let's pivot from your own immediate injuries to a scenario that's terrifyingly common on the streets of DC. Imagine you're driving down Connecticut Avenue, minding your own business. The light turns green, you proceed through the intersection, and bam! A car runs the red light and slams into your passenger side. It's a serious hit. Your car is crumpled, you're dazed, and your arm is definitely broken. The other driver doesn't even slow down. They just hit the gas and disappear into traffic. A classic hit and run. You're left on the side of the road in a wrecked car, in pain, with a huge problem. The person who is legally and financially responsible for this mess is gone. Vanished. So who pays? Who pays for your hospital bills, the surgery on your arm, the physical therapy you'll need for months? Who pays for your lost wages because you can't work? And who pays to repair or replace your car, which is now a twisted piece of metal? This is not a hypothetical, once-in-a-blue-moon scenario. This is a real everyday risk in the district. In fact, DC has one of the highest percentages of uninsured drivers in the entire country. Some estimates put it as high as 1 in every 7 drivers on the road with you right now. 1 in 7. Think about that the next time you're sitting in rush hour traffic on the Key Bridge. The person in front of you, behind you, next to you, statistically, one of them might not have a single dime of insurance. This is precisely why Washington, D.C. mandates our second critical piece of coverage, uninsured motorist protection, or UM. This is your financial bodyguard. It is the coverage that steps in and acts like the at-fault driver's insurance when they don't have any, or when they flee the scene. Without it, you could be left holding a mountain of bills for an accident that was 100% not your fault. Uninsured motorist coverage is actually broken down into two distinct parts, and it's critical you understand both. First, there's uninsured motorist bodily injury, or UMBI. This is the part that takes care of you and your passengers. It covers your medical expenses that go beyond what your personal injury protection, or PIP, covers. Remember how we said PIP is your first line of defense? Well, UMBI is your powerful second line of defense. It also covers things PIP doesn't, like lost wages if your injuries prevent you from working, and it can even provide compensation for pain and suffering. This is a huge deal. A car accident isn't just about the medical bills. It's about the life-altering trauma and chronic pain that can follow. UMBI is what provides financial recourse for that human cost when the responsible party can't be held accountable. The second part is uninsured motorist property damage, or UMPD. This one is pretty straightforward. It pays to fix your car. If that hit-and-run driver totals your brand new SUV, UMPD is what will pay you the actual cash value of that vehicle so you can go buy a new one. If it just needs a few $1,000s in repairs, UMPD covers that too, usually after you pay a small deductible, often around $250. It also covers damage to any other personal property that was in your car at the time of the crash. Now there's a close cousin to uninsured motorist coverage called underinsured motorist coverage, or UIM, and it's just as important. Let's go back to our intersection crash. This time, the driver who ran the red light doesn't flee. They pull over. They have insurance, which is a relief at first. But then you find out they only carry the bare minimum liability coverage required by DC law, which is $25,000 for bodily injury. Your medical bills alone, after the ambulance, the emergency room, the surgery on your arm, and the follow-up appointments are already at $80,000. And you still have months of physical therapy ahead of you, not to mention the fact you haven't been able to work for weeks. That other driver's $25,000 policy is a drop in the bucket. It will be exhausted almost instantly, leaving you with a $55,000 plus gap in medical bills, and that's before we even talk about your lost income or pain and suffering. This is where underinsured motorist coverage becomes your hero. It steps in to cover the difference between your actual costs and the at-fault driver's pathetic insurance limit. It bridges that massive, financially devastating gap. In Washington, D.C., uninsured and underinsured motorist coverages are typically bundled together. So when you buy UM, you're usually getting UIM as well. It's a package deal designed to protect you from both the completely irresponsible and the barely responsible. So, what are the mandatory minimums for this vital coverage in D.C.? The law says you must carry at least $25,000 per person for bodily injury, $50,000 per accident for bodily injury, and a shockingly low $5,000 for property damage. Let me be perfectly clear. These minimums are dangerously, almost laughably, inadequate. They are a financial time bomb waiting to go off. That $5,000 for property damage? What car in 2024 costs less than $5,000 to replace? A minor fender bender can easily exceed that amount in repair costs today. If your $30,000 car is totaled by an uninsured driver, the minimum required coverage would leave you $25,000 in the hole, with no car and no way to get to work. And the $25,000 for bodily injury? One night in a DC hospital can cost more than that. One single surgery can eclipse that limit. Relying on the state minimums is like bringing a water pistol to a wildfire. You are setting yourself up for financial ruin. So how much uninsured and underinsured motorist coverage should you actually have? The best and simplest rule of thumb is to match your UM/UIM limits to your liability limits. We're going to talk about liability limits in detail in the next section, but let's say you choose to protect yourself with $100,000 per person and $300,000 per accident in liability coverage. You should purchase the exact same amount, $100,000 per person and $300,000 per accident, for your uninsured and underinsured motorist bodily injury coverage. Why? The logic is simple and powerful. You should protect yourself and your family with the same level of financial security that you provide to a stranger you might accidentally injure. If you believe $100,000 is the right amount of coverage to pay for someone else's injuries if you're at fault, then it's certainly the right amount to cover your own injuries if someone else is at fault and can't pay. It's about creating a financial shield around your own life, your savings, and your future. For property damage, you should have enough UMPD to, at the very least, cover the full replacement value of your vehicle. Don't settle for the $5,000 minimum. Look up the Kelley Blue Book value of your car. If it's worth $25,000, you should have at least $25,000 in UMPD. Now I know what you're thinking. This sounds expensive. I'm just trying to get the cheapest policy possible. I get it. But of all the places to add coverage to your policy, UM/UIM is often the highest value for your dollar. The cost to increase your limits from the state minimum of $25.50 to a much safer $100-$300 is often surprisingly affordable. We're talking about a few extra dollars a month. A tiny price to pay to avoid a potential six-figure financial catastrophe. This isn't a luxury add-on. In a city with so many uninsured drivers, it is a fundamental necessity. It's the difference between a horrible accident being a temporary setback or a permanent, life-altering financial disaster. You are not insuring against a possibility. You are insuring against a statistical probability you will encounter on DC roads. So let's break down exactly what that statistical probability looks like and what the District of Columbia legally requires you to do about it. When you buy car insurance in DC, you're not just buying one single thing. You're buying a package of different coverages, and there are 3 specific types that are absolutely non-negotiable. You cannot legally drive a car registered in the district without them. These are the bare minimums, the floor of protection. And I want you to pay very close attention to how these work, because understanding them is the key to understanding why the bare minimum is one of the biggest financial risks you can take. First up is bodily injury liability. This is the big one. This coverage does not protect you. Let me repeat that, because it's the most common misconception in all of auto insurance. Bodily injury liability coverage does not pay for your medical bills. It pays for the medical bills, lost wages, and pain and suffering of other people if you cause an accident that injures them. You're driving down Connecticut Avenue, you get distracted by a text message, and you run a red light, T-boning another car. The driver and passenger in that other car are injured. Your bodily injury liability is what pays their hospital bills, their physical therapy, and the money they lose from being unable to work. The law in DC mandates you carry what's called $25.50 coverage. That breaks down like this. $25,000 is the maximum your insurance will pay out for any single person you injure in an accident. $50,000 is the maximum your insurance will pay out for the entire accident, no matter how many people are injured. Now you might hear $25,000 and think, that sounds like a decent amount of money, but let's put that number into the real world. That person you T-boned? The ambulance ride to George Washington University Hospital alone could be over $2,000. An MRI to check for spinal damage? Another $2,000 or $3,000. A few nights in the hospital for observation? You could easily be looking at $10,000 to $15,000 before any real treatment even begins. Now add in weeks of physical therapy, prescription medications, and the specialist visits. And we haven't even touched on the biggest cost: lost wages. If that person is a lawyer or a consultant who bills at several $100s an hour, and they're out of work for a month, that $25,000 limit is going to evaporate in the blink of an eye. And what happens when their bills hit $25,001? Your insurance company writes a check for $25,000 and wishes you the best of luck. That extra dollar? And the tens or even hundreds of thousands of dollars that could come after it. That's on you. Their lawyers will come after your personal assets, your savings account, your investments. They can put a lien on your home. They can garnish your future wages for years to come. That one moment of distraction on Connecticut Avenue could financially cripple you for the next decade. All because you only carried the legal minimum. The $50,000 per accident limit is even scarier. If you cause a pileup on the I-695 and injure 3 people, that $50,000 has to be split between all of them. It's not $50,000 each, it's $50,000 total. It is nowhere near enough for a serious multi-person accident. The second mandatory coverage is property damage liability. This one is more straightforward. It pays to repair or replace other people's property that you damage in an at-fault accident. This is usually the other person's car, but it could also be a city light pole, a storefront, or a homeowner's fence. The DC minimum requirement for this is a mere $10,000. $10,000. Let that sink in. Think about the cars you see every single day in the district. You're surrounded by Teslas, BMWs, new Autos, and high-end SUVs. The average price of a new car in the United States is now over $48,000. You gently rear-end a brand new Lexus in DuPont Circle. It doesn't even look that bad, just a cracked bumper and a broken taillight. But on a modern luxury car, that bumper is filled with sensors for parking assist, blind spot monitoring, and automatic braking. That headlight isn't a simple bulb. It's a complex, sealed LED matrix unit. The repair bill for that minor fender bender could easily soar past $10,000, $12,000, or even $15,000. Your insurance pays the first $10,000, and you get a bill for the rest. And if you total someone's car, if you slide on some ice and hit a brand new Ford F-150 that costs $60,000, you are personally on the hook for $50,000. That $10,000 minimum is a relic from a bygone era. It was designed for a world of $1,500 used cars, not a world of $60,000 pickup trucks with advanced driver assistance systems. Relying on it is like bringing a squirt gun to a wildfire. It gives you the illusion of being prepared, but when disaster strikes, you'll find it's completely and utterly useless. The third and final piece of the mandatory puzzle is uninsured motorist bodily injury coverage. Now this one is for you. This coverage steps in to pay for your medical bills if you are hit by a driver who is at fault and has no insurance at all, or in a hit-and-run situation where the driver is never found. The DC minimums for this mirror the liability limits: $25,000 per person and $50,000 per accident. This coverage is critically important. It's estimated that as many as 1 in 7 drivers on the road nationwide are uninsured. In a dense, transient area like the DMV, that number can feel even higher. So you do everything right. You're a safe driver, you have insurance. You're stopped at a light on Massachusetts Avenue, and someone plows into the back of you at 40 miles an hour. They get out of their car, and it turns out they have no license, no registration, and certainly no insurance. They have no job and no assets to their name. You can sue them, but you can't get blood from a stone. You're the one with whiplash and 3 herniated discs in your back. You're the one who needs surgery and can't work for 6 months. This is where your uninsured motorist coverage becomes your lifeline. But again, is that $25,000 minimum going to be enough to cover your own medical bills, your own lost wages, and your own recovery from an accident that wasn't even your fault? For any serious injury, the answer is a resounding no. It's a safety net with holes so large you could drive a truck through them. These 3 coverages, bodily injury liability, property damage liability, and uninsured motorist bodily injury, form the legal foundation of your DC auto policy. But as we've seen, this foundation is built on sand. It meets the letter of the law, but it completely fails to meet the reality of the road. The state minimums are not designed to protect you. They are designed to provide a minimal, often laughably inadequate amount of compensation to the people you might hit. They protect your legal right to drive, but they do almost nothing to protect your financial future. Think of it as a ticket to the game, but it doesn't guarantee you a seat, let alone a good one. So if the mandatory minimums are a financial trap waiting to be sprung, what's the solution? How do you actually protect yourself? That's where we move beyond what's required by law and into what's required by common sense. We start talking about the optional coverages that fill in the massive gaps left by the state minimums. Coverages that actually pay to fix your car, regardless of who is at fault. Coverages that provide much more robust protection for your own medical bills. These are the layers of armor that truly shield your savings, your assets, and your peace of mind from the chaos of DC traffic. Let's start with the most straightforward of these: collision coverage. This is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another vehicle or an object, like a light post on K Street, a guardrail on the Anacostia Freeway, or that deceptively high curb you didn't see when parallel parking in Georgetown. And here's the critical part. It covers you regardless of who is at fault. Because the accident, collision coverage is what fixes your car. If you're the victim of a hit and run, where the at-fault driver vanishes into the night, collision coverage is your savior. Without it, you're paying for those repairs entirely out of your own pocket. Now, with collision coverage comes a term you absolutely need to understand: the deductible. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance company starts paying. Think of it as your share of the repair cost. For example, if you have a $1,000 deductible and the damage to your car is $5,000, you pay the first $1,000, and your insurance covers the remaining $4,000. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium. It's a trade-off. You're essentially betting on your own driving. A higher deductible means you're betting you won't get into an accident, saving you money every month. A lower deductible is a more conservative approach, costing you more monthly but saving you from a big out-of-pocket expense if a crash does happen. In a city as unpredictable as DC, choosing the right deductible is a crucial financial decision. But what about the threats to your car that have nothing to do with driving? What about the hailstorm that rolls through in July, leaving dents all over your hood? What about the notorious DC car break-ins or, even worse, outright theft? What about a tree branch falling on your parked car during a storm in Rock Creek Park? This is where the second layer of armor comes in: comprehensive coverage. Comprehensive is for almost everything else that isn't a collision. It's the act of God and act of chaos coverage. It covers theft, vandalism, fire, flooding, hail, wind damage, falling objects, and even hitting an animal, like a deer on the Clara Barton Parkway. Just like collision, it has a deductible that you choose. Many people see comprehensive as a luxury, but in an urban environment like DC, it's a necessity. Think about the flash floods we've seen turn streets into rivers. Think about the crime rates. Without comprehensive coverage, if your car is stolen and never recovered, your insurance company owes you nothing. You're just out of a car, and still making payments on it if you have a loan. Collision and comprehensive together are what people often refer to when they say they have full coverage for their vehicle itself. But protecting your car is only half the battle. The most important asset you have isn't the metal, glass, and rubber you drive around in. It's you and your passengers. This is where we get into the two most tragically overlooked, yet arguably most important, coverages you can buy: uninsured and underinsured motorist protection. Let's call it UM/UIM for short. This right here is the coverage that can save you from financial ruin. Let me paint you a picture. You're driving responsibly down Connecticut Avenue, waiting at a red light. Suddenly, you're violently rear-ended by a driver who is texting. Your car is smashed and you feel a sharp searing pain in your neck and back. The ambulance comes, you go to the hospital. You have serious injuries that will require surgery, physical therapy, and weeks, maybe months off work. The other driver is clearly at fault, so their insurance will cover it all, right? Wrong. What if that driver has no insurance at all? It's illegal, but it happens every single day. Or what if they only have DC's bare minimum liability coverage, which is just $25,000 for bodily injury per person? Your initial ambulance ride and emergency room visit could eat up a huge chunk of that. Your surgery alone could cost $50,000, $60,000, $100,000 or more. Add in the lost wages from not being able to work, the cost of ongoing physical therapy, the chronic pain. That $25,000 minimum is a pathetic drop in an ocean of debt. So what happens? The at-fault driver's insurance pays out their tiny limit, and then you're on your own. You can try to sue the driver personally, but if they couldn't afford more than the minimum insurance, what are the odds they have $100,000 in assets for you to claim? The odds are virtually zero. This is the nightmare scenario. This is where your entire life can be upended by someone else's irresponsibility. And this is where uninsured and underinsured motorist coverage becomes your personal superhero. UM/UIM steps in and acts as the insurance the other driver should have had. It covers your medical bills, your lost wages, and even compensation for your pain and suffering, up to the limits you select. If the other driver had no insurance, your uninsured motorist coverage kicks in. If they had some insurance but not enough to cover your bills, your underinsured motorist coverage pays the difference. You get to choose your UM/UIM limits. They often mirror the liability limits you chose for yourself. So if you chose 100/300/50 liability, you can get 100/300 UM/UIM. This means you are giving yourself the exact same level of protection that you're giving to strangers on the road. It is, without a doubt, one of the most selfless and smartest things you can do for yourself and your family. In a transient city like DC, with drivers from all over the country and varying levels of financial responsibility, driving without high limits of UM/UIM coverage is one of the biggest gambles you can possibly take. But wait, there's one more piece to this personal protection puzzle. It's called medical payments coverage, or MedPay. Think of MedPay as the immediate first aid for your finances after an accident. While UM/UIM is designed for more serious injuries and the long-term financial fallout, MedPay is for the immediate costs, and it pays out regardless of who is at fault. Let's go back to our accident scenario. Even if you have great health insurance, you probably have a deductible, copays, and coinsurance. If you need an ambulance, go to the ER, and need x-rays, you might get a stack of bills totaling a few $1,000s that you have to pay before your health insurance fully kicks in. MedPay covers these immediate costs. If you have $5,000 in MedPay coverage, it can pay for that ambulance ride, the emergency room copay, those initial doctor's visits, and even dental work if needed for you and anyone in your car. There is no deductible, just pays right away. This can be a huge relief, preventing you from having to put medical bills on a credit card while you wait for the larger insurance claims to be sorted out, which can take months or even years. It's relatively inexpensive to add to your policy and provides incredible peace of mind for those immediate and often unexpected out-of-pocket costs. So let's put it all together. Liability coverage is your legal shield to protect your assets from others. Collision and comprehensive are the armor that protects the value of your vehicle from accidents and chaos. And finally, uninsured/underinsured motorist and MedPay are your personal life raft, protecting your health, your body, and your financial future from the devastating consequences of a serious accident, especially one caused by someone who can't make you whole. This suite of coverages is what a truly robust, protective insurance policy looks like. It's far more than the legal minimum. It's a comprehensive strategy for managing the very real risks of driving in the nation's capital. Now, you've probably heard insurance agents or commercials talk about full coverage. It's important to know that full coverage is not an official insurance term. It's a piece of slang, and it can be dangerously misleading. Generally, when people say full coverage, they just mean a policy that includes liability, collision, and comprehensive. But as we just discussed, that leaves a massive, gaping hole where your personal protection should be. A truly great policy isn't just about fixing your car. It's about fixing your life when things go horribly wrong. It must include high limits of uninsured and underinsured motorist coverage and a healthy amount of MedPay. Never assume full coverage includes these. You have to ask for them. You have to insist on them, because the difference between having them and not having them isn't measured in monthly premiums. It's measured in your ability to recover and rebuild your life after the worst happens. And now we have to talk about the numbers, because having the right types of coverage is only half the battle. The other half, the part that separates financial security from financial ruin, is having the right amount of coverage. This is where the single biggest, most dangerous myth in car insurance lives. It's a myth whispered by insurance company websites trying to give you the lowest possible quote. It's a myth reinforced by the government itself. And it's the myth of the state minimum. Every state, and the District of Columbia, sets a legal floor for liability insurance. It's the absolute least you can carry to legally operate a vehicle. In DC, those minimums are what's known as 25/50/10. Let me break that down. $25,000 for bodily injury to one person. $50,000 total for bodily injury to everyone in an accident you cause. And a measly $10,000 for property damage. Let's be brutally honest. Calling this coverage is a marketing gimmick. It's not coverage. It's a legal permission slip to drive. It's designed to protect other people from you, but only up to a laughably small amount. It does almost nothing to protect you, your savings, your home, your future earnings, from the consequences of a serious accident. Relying on state minimum insurance is like going into a sword fight armed with a plastic fork. You've technically brought something to the fight, but you are going to lose badly. To understand why, let's leave the world of abstract numbers and enter the real world. Let's create a scenario. Meet Sarah. Sarah is a young professional living in Logan Circle. She's smart, she's responsible, but she's also trying to manage her budget in one of the most expensive cities in America. When she bought her car insurance, she saw the option for state minimum, and it was the cheapest. She thought, I'm a safe driver, I've never had an accident. This is all I'm legally required to have, so it must be enough. She saved about $40 a month, a little over $1 a day. One rainy Tuesday afternoon, she's driving down Massachusetts Avenue. Traffic is heavy. She gets a notification on her phone, which is in a cradle on her dash. It's a calendar reminder for a big meeting. For just 1 second, she glances down to dismiss it. 1 second. That's all it took. When she looks up, the brake lights on the Tesla Model 3 in front of her are blazing red. She slams her brakes, but the wet pavement betrays her. She rear-ends the Tesla, pushing it forward into the back of a brand new Lexus RX SUV. A classic 3-car, chain reaction fender bender. Nobody seems seriously hurt at first, just shaken up. The police come, reports are filed, tow trucks are called. Sarah, stressed but relieved nobody went to the hospital, calls her insurance company and starts the claim. She thinks, this is why I have insurance. And this is where her world begins to unravel. A week later, the calls start. First, the estimate for the Tesla. Modern cars, especially electric ones with sensors and batteries, are incredibly expensive to repair. The rear bumper, the trunk, the underlying sensors and frame components, the total repair bill for the Tesla comes to $21,000. Then the Lexus. It's newer, larger, and the damage is similar. Its repair bill is $24,000. The total property damage Sarah is responsible for is $45,000. Sarah takes a deep breath and remembers her policy. Her property damage limit, that last number in the 25/50/10 sequence, is $10,000. Her insurance company will write a check for $10,000. And that's it. The remaining $35,000? That's now Sarah's personal debt. The other two insurance companies will pay to fix their clients' cars, and then their lawyers will turn to Sarah to collect every last cent. But it's about to get so much worse. 2 weeks after the accident, the driver of the Tesla, a lawyer in his 40s, starts experiencing severe neck and back pain. Whiplash. He goes to the doctor, gets an MRI, and is prescribed 6 months of intensive physical therapy. The driver of the Lexus, a woman in her 50s, hit her head on the steering wheel. She has a concussion, and her wrist is fractured from the impact. She's an architect who needs her hand to draw and use a computer. She's going to be out of work for at least 3 months. Let's tally up the human cost. The lawyer's medical bills for the ER visit, the MRI, the specialist consultations, and the physical therapy come to $30,000. The architect's medical bills for her ER visit, the orthopedic surgeon, the cast, and the neurological follow-ups for her concussion come to $40,000. On top of that, she has a claim for lost wages because she can't do her job. That's another $25,000. The total demand for bodily injury is now $30,000 for person 1 and $65,000 for person 2. That's a total of $95,000. Sarah goes back to her policy documents. 25/50/10. The first number, 25, is the most her insurance will pay for any one person's injuries. The second number, 50, is the most her insurance will pay for all injuries in the accident combined. So for the lawyer, whose bills are $30,000, Sarah's policy pays out the maximum of $25,000. He is now personally suing Sarah for the remaining $5,000. For the architect, whose bills and lost wages total $65,000, Sarah's policy again only pays the per-person limit of $25,000. She is now personally suing Sarah for the remaining $40,000. The math is a nightmare. Her policy paid out its full limit, $50,000 for injuries and $10,000 for property damage, a total of $60,000. But the total cost of the accident was $45,000 in property damage and $95,000 in bodily injury, a grand total of $140,000. The shortfall, the amount Sarah is now personally responsible for, is $80,000. That $40 a month she saved? That $1,440 she saved over 3 years of safe driving? It has just cost her $80,000. Her savings will be wiped out. A court will issue a judgment against her. Her wages will be garnished for years, maybe decades. If she owns a home or has other assets, liens will be placed against them. Her driver's license will be suspended until she can satisfy the judgment. That 1-second glance at her phone didn't just cause an accident. It triggered a financial catastrophe that will derail her entire life. All because she chose a policy that was legally compliant, but practically useless. This isn't a scare tactic. This happens every single day. So what's the solution? The solution is to treat the state minimum as what it is, a trap to be avoided at all costs. The absolute, bare-bones starting point for responsible coverage should be 100/300/100. Let's run Sarah's accident again with these limits. $100,000 for one person's injuries, $300,000 for all injuries in an accident, $100,000 for property damage. The property damage was $45,000. With a $100,000 limit, her insurance covers all of it. Every penny. She pays her deductible and that's it. The lawyer's $30,000 injury claim? Covered in full, with $70,000 to spare on her per-person limit. The architect's $65,000 claim? Covered in full. The total $95,000 injury bill is well under her $300,000 accident limit. In this scenario, Sarah's insurance company handles everything. The lawyers, the claims, the payments. She is protected. Her savings are safe. Her future is secure. Her life goes on. The difference in premium between a 25/50/10 policy and a 100/300/100 policy isn't negligible, but it is microscopic compared to the difference in outcome. It's the difference between inconvenience and insolvency. And for those of you who have more to protect, a home, a healthy retirement account, a business, even 100/300/100 might not be enough. That's where you need to have a serious conversation about an umbrella policy. An umbrella policy is exactly what it sounds like. It's an extra layer of liability protection, typically sold in increments of $1 million, that sits on top of your auto and home insurance. If a catastrophic accident happens and you exhaust your auto liability limits, the umbrella policy kicks in to protect you from that life-altering lawsuit. It is, for its price, one of the best bargains in the entire insurance industry. Choosing your liability limits isn't a budget decision. It's a risk management decision. You're not just buying a policy, you're building a financial fortress around your life. And the foundation of that fortress is choosing liability limits that reflect the reality of the world we live in, not a legal minimum set decades ago. It's about protecting everything you've worked for, and everything you will work for from that one single unpredictable second on the road. Now let's pivot for a second. We've just spent a lot of time talking about what happens if you cause an accident. We've talked about protecting your assets, your future, your entire financial life from a lawsuit. But what happens when you do everything right? You're stopped at a red light on Massachusetts Avenue. You're patiently waiting in traffic on the Roosevelt Bridge. You're driving the speed limit through a green light in Georgetown, and someone else, through their own negligence, slams into you. You'd think, okay, this is awful, but at least they're at fault. Their insurance will cover it. That is a perfectly logical assumption. It is also, in Washington, D.C. and the surrounding metro area, a dangerously naive one, because you are making one gigantic assumption, that the other driver is as responsible as you are. You're assuming they have insurance at all, or that they have enough insurance to actually cover the damage they've just caused. The reality is terrifying. Studies consistently show that roughly 1 in 8 drivers on the road nationally is uninsured. 1 in 8. And in a dense, transient urban area like DC, that number is often higher. Think about that. The next time you're driving down K Street, look at the 8 cars around you. Statistically, one of them has no insurance. They are a financial time bomb waiting to go off. And that doesn't even count the ones who are underinsured. The people who carry only the bare legal minimum. A safety net so full of holes it's practically useless. Let me paint you a picture. Let's invent a driver, we'll call her Maria. Maria is a consultant living in Logan Circle. She drives a 3-year-old SUV that's worth about $40,000. She's smart, she's got a great job, and she's protected herself with good liability insurance, let's say 250/500/100, just like we talked about. She's done everything right. One morning, she's driving to a client meeting in Virginia. A driver in an old sedan runs a stop sign and T-bones her. The impact is severe. Her SUV is totaled. The airbags deploy and she's rushed to the hospital with a concussion, a broken arm, and several fractured ribs. The police report is clear. The other driver is 100% at fault. In the hospital, Maria is shaken, but she feels a small sense of relief. At least she doesn't have to worry about the financial side. The other driver's insurance will pay for her $40,000 car, her ambulance ride, her emergency room visit, her surgery, her physical therapy, her lost wages from being unable to work for 6 weeks. Her medical bills alone quickly soar past $75,000. A week later, she gets the call from her insurance agent. The news is a gut punch. The driver who hit her had insurance, all right? They had the DC legal minimum. $25,000 for property damage. $25,000 for bodily injury. Let's do the math. His insurance company sends a check for $25,000 for her totaled SUV. That leaves Maria $15,000 short on just her vehicle replacement. Then, his insurance sends another check for $25,000 for her medical bills. But her bills are over $75,000 and still climbing. She is now personally on the hook for the remaining $50,000 in medical costs, plus her $15,000 car deficit, plus all of her lost income. She's out $65,000, and that's before we even talk about pain and suffering. She can sue the other driver, sure. But what if he has no assets? What if he's a college student or works a minimum wage job? You can't get blood from a stone. A court judgment is just a piece of paper if the person you're suing has nothing to give. In an instant, Maria went from being the victim of an accident to the victim of a financial catastrophe. all because the person who hit her chose to be irresponsible. This is not a rare scenario. This happens every single day in this city. And this is precisely why the next two coverages we're going to talk about are, in my opinion, just as important as liability. They are uninsured motorist and underinsured motorist coverage. Let's call them UM and UIM. Think of UM and UIM as your personal financial bodyguard. They step in and protect you when the at-fault driver can't or won't. Let's start with uninsured motorist, or UM. This one is straightforward. It protects you if you're hit by a driver with no insurance whatsoever. It also, and this is critically important for city living, protects you in the event of a hit and run. Someone sideswipes you and speeds off? Someone rear-ends you and flees the scene? From your insurance policy's perspective, that is an uninsured motorist. Without this coverage, you are completely on your own. Your uninsured motorist coverage steps in and plays the role of the insurance the other guy should have had. It pays for your medical bills, your lost wages, your pain and suffering. Now let's talk about underinsured motorist, or UIM. This is the coverage that would have saved Maria. UIM coverage kicks in when the at-fault driver has insurance, but their liability limits are too low to cover your damages. It pays the difference between their lowball limit and the actual cost of your injuries. In Maria's case, the other driver had a $25,000 limit. Her medical bills were $75,000. If Maria had carried a $250,000 UIM limit, her own policy would have stepped in to cover that $50,000 gap and would have continued to pay for her ongoing care up to her policy limit. It would have turned a financial disaster into a manageable inconvenience. Now, just like liability, UM and UIM coverage is split into two parts: bodily injury and property damage. Uninsured/underinsured motorist bodily injury, UMBI/UIMBI, is the one that covers your medical expenses, your passengers' medical expenses, and lost income. DC law actually requires you to carry minimum limits of uninsured motorist coverage, which are 25/50ths. But as we saw with Maria, that is a horrifically inadequate amount. Here is the single most important piece of advice I can give you on this topic. Your UM/UIM bodily injury limits should always be equal to your own bodily injury liability limits. If you have $250/500 in liability to protect others, you should have $250/500 in UM/UIM to protect yourself. It begs a very simple question. Why on earth would you buy more insurance to protect a random stranger you might hit than you would to protect yourself and your own family from that same random stranger? The cost to increase these limits is often surprisingly small, and the protection it offers is immense. It is the best bargain in the entire insurance contract. Then there's the property damage side. In DC, you're required to have $5,000 in uninsured motorist property damage, or UMPD. This helps pay to repair or replace your car if it's damaged by an uninsured driver, including a hit and run. Now, $5,000 is obviously not enough to replace most cars on the road today. This is where your collision coverage, which we'll discuss next, comes into play. But having that UMPD can often be enough to cover your collision deductible, making a bad situation a little bit easier. The bottom line is this: liability insurance protects your assets from a world of people you might harm. Uninsured and underinsured motorist coverage protects your body and your bank account from a world of irresponsible people who might harm you. You are paying for your own policy to shield you from the financial fallout of someone else's bad decisions. In a city where you share the road with millions of commuters, tourists, and residents from 3 different jurisdictions every single day, you have no idea who is in the car next to you. You have no idea if they have insurance, or if that insurance is worth the paper it's printed on. UM and UIM coverage means you don't have to gamble on their responsibility. You're taking control of your own protection. So we've covered your legal and financial responsibility to others. We've covered your financial protection from others. But we still haven't talked about the big, expensive metal and glass object at the center of all this, your car itself. What happens when you hit a patch of black ice on the Key Bridge and slide into a guardrail? What happens when a tree branch falls on your car during a thunderstorm in Chevy Chase? What happens when your car is stolen from a parking garage downtown? For all of that, we need to talk about the 2 coverages that actually fix your car no matter who is at fault. And that's collision and comprehensive. Collision and comprehensive. Let's make this simple. Think of it this way. Collision coverage protects your car from your driving mistakes. Comprehensive protects your car from the world's mistakes. They are the 2 parts of your policy that pay to fix or replace your vehicle. Let's break down collision first, because it's the one most people think of when they hear car accident. Collision coverage is exactly what it sounds like. It pays for damage to your car when you collide with another object. That object is usually another car, but it doesn't have to be. It could be a light pole on Massachusetts Avenue, a parking garage pillar on K Street, or the curb you misjudged while trying to squeeze into a tight spot in Adams Morgan. The most important thing to understand about collision coverage is this. It pays out regardless of who is at fault. Let's imagine a scenario. You're driving down Connecticut Avenue, you glance at your phone for a split second, and you rear-end the car in front of you. It is 100% your fault. Your bodily injury and property damage liability, which we talked about before, will pay for the other driver's medical bills and the repairs to their car. But what about your car? Your front end is crumpled. Without collision coverage, you are paying for that repair entirely out of your own pocket. With collision coverage, your insurance company steps in to pay for the repairs. Now let's flip it. Someone runs a red light and T-bones you in an intersection in Georgetown. It's clearly their fault. Their property damage liability should pay for your car. But what if they're one of the thousands of uninsured drivers in the district? Or what if they have the bare minimum coverage, and your brand new car has $40,000 in damage but they only have $10,000 in coverage? Or what if their insurance company decides to drag its feet, investigating the claim for weeks while you're stuck without a car? In all of these situations, you can file a claim under your own collision policy. Your insurance company will pay to get your car fixed right away, and then they'll go after the other driver's insurance company to get their money back. This process is called subrogation. For you, it means you're not left waiting and fighting while your car sits in a body shop. You get your car fixed and let the insurance giants battle it out. But there's a catch, and it's called the deductible. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance coverage kicks in. Deductibles for collision coverage typically range from $500 to $1,000, but they can be higher or lower. Let's say you have a $1,000 deductible. You get into that fender bender, and the repair bill is $6,000. You pay the first $1,000, and your insurance company pays the remaining $5,000. If the damage is only $800, you just pay for it yourself, because it's less than your deductible and not worth filing a claim over. Choosing your deductible is a balancing act. A higher deductible means you're taking on more financial risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means less out-of-pocket pain if you have an accident, but you'll pay more for your policy every month. It's a personal choice based on your risk tolerance and how much cash you could comfortably come up with on short notice. So that's collision. It's for crashes. But what about all the other chaos the world can throw at your car? That's where comprehensive coverage comes in. The official name is actually other than collision coverage, which is a much better description. It covers damage to your car from basically anything other than a collision. Think about the risks unique to living in or around DC. A summer thunderstorm pops up, and a massive tree branch from an old oak in Rock Creek Park cracks and falls right onto the hood of your parked car. That's a comprehensive claim. You park your car at a metro station for the day, and come back to find your window smashed and your stereo gone. Vandalism and theft, both covered by comprehensive. A flash flood turns Canal Road into a river, and your car gets water damage. Comprehensive. You're driving on the GW Parkway at dusk, and a deer jumps out in front of you. Hitting an animal is not considered a collision. It is a classic comprehensive claim. This is a critical distinction. Hit a deer, it's a comprehensive claim. Swerve to miss the deer and hit a guardrail instead? That's a collision claim. The outcome is the same, a damaged car, but the type of claim is completely different. Comprehensive covers fire, riots, civil commotion, falling objects, and hail. It is the coverage that protects your car from acts of God and acts of people that have nothing to do with your driving. Just like collision, it has a deductible, and you can actually choose different deductibles for each. For example, you might have a $1,000 deductible for collision because you trust your driving, but a lower $250 deductible for comprehensive because you can't control hailstorms or thieves. Many insurers also offer a $0 deductible for glass claims, meaning a stray rock chips your windshield on I-66, and you can get it fixed with no out-of-pocket cost. Now for the big question you're probably asking. Do I actually need these? Unlike liability insurance, collision and comprehensive are not required by DC law. So, is it optional? Well, it depends. If you have a loan or a lease on your car, the answer is almost certainly no, it is not optional. Your lender, the bank or the finance company, technically owns your car until you pay it off. is their asset and they need to protect their investment. Your financing agreement will almost universally require you to carry both collision and comprehensive coverage with a maximum deductible amount, usually $500 or $1,000. If you drop this coverage, your lender can actually buy a policy for you called force-placed insurance and tack the very expensive bill onto your loan payment. So if you have a car payment, you need full coverage. But what if you own your car outright? No loan, no lease, the title is in your name. Now it's a purely financial decision. And here's how you should think about it. First, you need to know what your car is actually worth. Not what you paid for it, but its actual cash value or ACV. That's the make, model, year, mileage, and condition minus depreciation. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Once you know your car's value, you can apply a simple rule of thumb, the 10% rule. If the annual cost for your collision and comprehensive coverage is more than 10% of your car's value, you should seriously consider dropping it. For example, if your car is worth $3,000, 10% of that is $300. If your full coverage is costing you $600 per year, you're paying a lot to protect a relatively low-value asset. You might be better off banking that $600 and saving it for repairs or a down payment on a new car. But the most important question is the sleep at night test. Ask yourself this: if I walked outside tomorrow and my car was gone, stolen, or totaled in a hit and run, could I afford to replace it without putting myself in a massive financial hole? Could I write a check for $5,000, $10,000, or $20,000 to get myself back on the road? If the answer is a hard no, then you absolutely need collision and comprehensive coverage. It's not just insurance for your car, it's insurance for your financial stability. It transforms a potentially catastrophic, budget-destroying event into a manageable inconvenience where your only out-of-pocket cost is your deductible. So we've covered the big three: liability to protect others from you, and collision and comprehensive to protect you from the world. These form the core of any auto policy, but they don't cover everything. What happens when your car is in the shop for a week after an accident and you still need to get to work? Who pays for that rental car? What about when you get a flat tire on the Roosevelt Bridge during rush hour and need a tow? These everyday headaches aren't covered by the main policies we've discussed. They fall under a category of optional coverages, the add-ons that can feel like a money grab, but can also be absolute lifesavers. These optional coverages, the ones most people skim over, can be the difference between a minor inconvenience and a week-long financial nightmare. So let's break down the add-ons that are actually worth your money. First up is rental reimbursement. And this one is so important in a city like DC where not having a car can completely derail your life. Picture this: you're driving down Connecticut Avenue during rush hour. Traffic is a nightmare, bumper to bumper. The person behind you is texting, looks up too late, and bam! It's not a huge crash. No one's hurt, thank goodness. But your rear bumper is toast. Your car is drivable, but it needs to go into the shop. You drop it off at the body shop and the mechanic gives you the news: with the supply chain issues for parts, we're looking at about 8 days to get this fixed. 8 days. Think about that. How do you get to work in Arlington? How do you pick up the kids from school? How do you get groceries? You could take the metro, sure, but that adds an hour to your commute each way. You could Uber everywhere, but in DC, that's going to cost you $50, $60, maybe $100 a day. Over 8 days, you're looking at a bill of $500 to $800 out of your own pocket, all because someone else wasn't paying attention. This is where rental reimbursement coverage becomes your hero. For what usually costs a few extra dollars a month, less than a single fancy coffee, your insurance company will pay for your rental car while yours is being repaired after a covered claim. It's that simple. Instead of frantically calculating Uber surge pricing, you just make a call, and you're in a rental back on the road with your life uninterrupted. Now, here's the pro tip. Don't just check the box for this coverage. Look at the limits. A standard option might be something like $30 per day, with a maximum of $900 total. Ask yourself, can you actually rent a car in the DC metro area for $30 a day? Probably not. You might need to bump that coverage up to $40 or $50 a day. It will cost pennies more per month, but it ensures you're not stuck paying the difference or driving the smallest, most basic car on the lot. It's about matching the coverage to the real-world cost. Next on the list is another one that feels like a luxury until the moment you desperately need it: roadside assistance. Imagine it's 10 p.m. on a Saturday. You're leaving a friend's place in Adams Morgan, and you get to your car in a parking garage. You turn the key, and nothing. Just a sad little clicking sound. Your battery is completely dead. Your heart sinks. Who do you even call? A tow truck company you find on Google? How much is that going to cost you at this time of night? $150? $200? Plus the wait time sitting alone in a dark garage. Or maybe you're driving on the I-495 Beltway, and you hear that dreaded thumping sound. A flat tire. In the middle of rushing traffic. It's not just an inconvenience, it's genuinely dangerous. For the price of a burger and fries each month, roadside assistance through your insurance policy eliminates this entire nightmare scenario. You get a flat tire, you call the number on your insurance card, and they send someone to change it. Dead battery, they send someone to give you a jump. Run out of gas, they'll bring you a few gallons. Lock your keys in the car, they'll send a locksmith. It turns a potential crisis into a manageable problem. The insider secret here is to compare it to standalone services like AAA. Often, the roadside assistance from your insurance company is cheaper. However, it might have more limitations. For example, it might only cover towing for up to 15 miles, while AAA might cover 100 miles. It might also have a limit on how many times you can use it per year. So, if you have an older, less reliable car or a very long commute, a premium AAA membership might be better. But for most drivers with a reliable vehicle, the insurance add-on is the most cost-effective way to buy that priceless peace of mind. Okay, let's move on to the big one. The one that can literally save you from financial ruin if you have a car loan. I'm talking about gap insurance. And if you are financing or leasing your car, you need to listen very closely. Let's set the scene. You did it. You bought your dream car. It's brand new, smells amazing, and you feel incredible driving it. You put a few $1,000s down and finance the rest. Let's say you have a $35,000 loan. The moment you drove that car off the dealership lot, something called depreciation began. Your car started losing value. A week later, you're driving through an intersection and someone blows through a red light, T-boning your car. It's a total loss. The car is completely destroyed. You file a claim with your insurance. After their assessment, they determine the actual cash value, the market value of your car right before the crash. Because of that first week depreciation, its value is now only $29,000. Your collision coverage pays out that $29,000. But wait, you still owe the bank $35,000. The insurance check pays off most of it, but there is a $6,000 difference. A gap. And guess who has to pay it? You do. You are now legally required to keep making payments, $6,000 worth, on a car that is sitting in a junkyard. It is an absolute financial gut punch. Gap insurance prevents this. It is specifically designed to pay off that exact difference, the gap between what your insurance company pays you and what you still owe on your loan or lease. It covers that $6,000 void, pays off the bank, and lets you walk away financially whole, ready to start fresh. And now for the most important tip I can give you about this. Do not automatically buy gap insurance from the car dealership. The dealership's finance office will almost always try to sell it to you, often rolling it into your car loan for a hefty price, sometimes $1,000 or more. Before you sign anything, call your insurance agent. 9 times out of 10, you can add gap insurance directly to your auto policy for a fraction of the cost. We're talking a few dollars a month versus a huge lump sum. And one more thing, gap insurance isn't needed forever. Once you've paid down your loan to the point where you owe less than the car is worth, you can call your insurance company and cancel it to save even more money. Building on that, there are 2 other related coverages for specific situations. First is new car replacement. Think of this as gap insurance on steroids. If your new car is totaled, instead of just paying off the loan, this coverage will pay to replace it with a brand new car of the same make and model, same year. It completely ignores depreciation. It's more expensive, but if you're someone who wants zero hassle and wants to be put right back in the driver's seat of a new vehicle, it's an amazing option. The second is custom parts and equipment coverage. Did you install a new sound system? What about those expensive custom rims or that special paint job? Your standard policy will not cover those things. It only covers the factory-installed parts. If your car is stolen or totaled, you'll get paid for a stock stereo and factory wheels, and that $5,000 you invested in upgrades is just gone. This add-on specifically covers your custom parts, but you have to be smart about it. Keep every single receipt and take detailed photos of the equipment. You'll need to provide proof of value if you ever make a claim. Finally, let's talk about the ultimate get-out-of-jail-free card: accident forgiveness. We all try to be perfect drivers, but mistakes happen. A moment of distraction, a misjudgment of distance, and suddenly you're in your first at-fault fender bender in 15 years. Without accident forgiveness, that one mistake could cause your insurance rates to spike by 30 or 40%, and that increase can stick around for 3 to 5 years. It's a penalty that can cost you thousands of dollars over time. Accident forgiveness is exactly what it sounds like. If you have this on your policy, your insurance company will forgive your first at-fault accident. They won't raise your rates. The surcharge that would normally be applied is simply wiped away. It's a reward for your long-term loyalty and good driving record. The key here is to understand the rules. Usually, you have to earn it. Many companies require you to be a customer and be accident-free for a certain number of years, maybe 3 or 5, before the benefit kicks in. Some companies let you purchase it outright from day one. You need to ask your agent how it works. Does it apply to every driver on the policy, or just the primary one? Is there a limit to the severity of the accident it will cover? Knowing these details makes the coverage even more powerful. It's not just an add-on. It's a shield for your wallet against one single bad day on the road. And speaking of shields for your wallet, let's talk about the single most powerful way to lower the cost of that shield: discounts. This isn't just about saving a few bucks here and there. We're talking about strategically stacking discounts to slash your DC car insurance premiums by potentially hundreds, or even over $1,000 a year. Most people know about the obvious ones like a safe driver discount, but the real savings are hidden in plain sight, and insurers aren't exactly shouting them from the rooftops. First, and this is the big one, is the multi-policy or bundling discount. If you have renter's insurance or homeowner's insurance, you should almost always have it with the same company as your auto insurance. The discount is often massive, frequently between 10 and 25% off your entire premium. Why? Because from the insurer's perspective, you're a stickier, more loyal customer. They're willing to give you a steep discount to get all of your business. If you're renting an apartment in Adams Morgan or own a home in Georgetown and your policies are with different companies, you are very likely leaving free money on the table. It's the first question you should ask when getting a quote. Next, let's talk about something you can proactively do right now. Take a DC DMV-approved defensive driving course. Yes, it costs a small amount of money and a few hours of your time. But completing one of these courses can earn you a mandatory discount on your insurance for up to 3 years. It's a guaranteed return on your investment. You're not just hoping to get a discount, you are actively earning it. It proves to the insurance company that you're serious about being a safer driver, and they will reward you for it. Now for a discount that's incredibly relevant in the district: the low mileage discount. DC is one of the most walkable cities in the country, with an extensive metro system. Many residents barely use their cars, maybe just for weekend trips to Virginia or Maryland. If you drive less than the average, which is typically around 10,000 to 12,000 miles per year, you need to tell your insurance company. Some companies offer significant savings for driving under 7,500 miles, or even under 5,000. Why should you pay the same premium as someone commuting an hour each way on the Beltway every single day? You shouldn't. You are a lower risk and your rate should reflect that. This brings us to the modern-day version of the low-mileage discount: telematics, or usage-based insurance. This is where companies like Progressive with their Snapshot device or State Farm with their DriveSafe and Save app use technology to monitor your actual driving habits. Now, I know what you're thinking: privacy. And that's a valid concern. You have to be comfortable with the company tracking things like your speed, how hard you brake, the time of day you drive, and your phone usage. But here's the upside. If you are genuinely a safe driver, this can be the single biggest discount you can get. It replaces their assumptions about you with cold, hard data. If you don't speed, you don't slam on your brakes, and you avoid late-night driving, you could see your rates plummet by as much as 30 or even 40%. It's the ultimate way to prove you deserve a lower rate. Don't forget about group or affinity discounts. Are you a member of an alumni association, a professional organization like the American Bar Association, or a medical group? Are you a federal employee, a veteran, or an active duty military member? Hundreds of organizations have negotiated group discounts with major insurance carriers. It takes 5 minutes to check your organization's member benefits page or to simply ask an insurance agent, "Do you have a discount for members of X?" It's a simple question that could unlock another 5 to 10% in savings. Now let's talk about something that operates in the background, something most people don't even realize is dramatically impacting their car insurance rates in DC: your credit score. This is a sensitive topic, but it is financially critical to understand. Insurance companies have found a strong statistical correlation between a person's credit history and the likelihood they'll file a claim. The logic, from their perspective, is that someone who is responsible with their finances tends to be responsible in other areas of their life, including behind the wheel. It's not about how much money you have. It's about how you manage it. A poor credit-based insurance score can raise your rates more than a minor at-fault accident. So what can you do? First, check your credit report for free. Look for errors and dispute them. Second, focus on the fundamentals. Pay all your bills on time every time. Keep your credit card balances low. This isn't just good advice for getting a loan. It's a long-term strategy for lowering your insurance premiums for years to come. Alright, let's shift from discounts to a strategic choice you have to make: your deductible. The deductible is the amount of money you pay out of pocket for a collision or comprehensive claim before your insurance kicks in. There's an inverse relationship here that's crucial to master. The higher your deductible, the lower your monthly premium will be. Raising your deductible from $250 to $500, or from $500 to $1,000, can save you a significant amount of money each year. But here's the golden rule for choosing a deductible. Never choose a deductible that you could not comfortably pay in cash tomorrow without causing a financial crisis. If a $1,000 bill would force you to go into debt, then it's too high. A great strategy is to choose a higher deductible, say $1,000, and then take the money you save on your premium each month and put it into a separate savings account. Once that account hits $1,000, you've essentially self-funded your deductible. From that point on, all the premium savings are pure profit and you're protected. Finally, the single most important piece of advice I can give you for saving money on DC car insurance is this: you must shop around. I cannot stress this enough. Loyalty to an insurance company is almost never rewarded. In fact, it's often punished through a practice called price optimization, where companies slowly raise the rates on long-term customers who are unlikely to switch. You should be comparing quotes at least once a year, or every time your policy is up for renewal. And you absolutely must shop around after any major life event. If you get married, move to a different zip code within the district, buy a new car, or after an accident or ticket falls off your record, which is typically after 3 to 5 years. When you shop, make sure you're comparing apples to apples. Get quotes for the exact same liability limits, the same deductibles, and the same optional coverages. And don't just use one online tool. Get quotes directly from company websites, use a comparison site, and call an independent insurance agent. An independent agent is a secret weapon because they can shop multiple carriers for you at once, and often have access to companies or discounts you can't find on your own. They can provide personalized advice that a website algorithm simply can't. Finding the cheapest rate in DC isn't about finding one magic company. It's about the process of methodical, regular comparison. It's the only way to ensure you're not overpaying. By combining these strategies, aggressively pursuing every discount, managing your credit, choosing a smart deductible, and consistently shopping the market, you're no longer a passive price taker. You're an active, empowered consumer taking control of one of your biggest expenses. But all these savings and all this preparation mean nothing if you don't know what to do when that dreaded moment actually arrives. Filing a claim after an accident is a minefield of its own, and one wrong move, one wrong word to an adjuster, can cost you everything you've saved and more. So let's paint the picture. Tires screech, metal crunches, that sickening jolt throws you forward. Your heart is pounding in your chest. The first few seconds are a blur of adrenaline and disbelief. This is the moment where your financial future for the next several years is decided. Your first instinct might be to get out and say, "I'm so sorry." Don't. Your first instinct might be to check on the other driver and, in a moment of shock, agree that it all happened so fast. Don't. In Washington, D.C., these simple human reactions can be million-dollar mistakes. Here's why. The District of Columbia operates under a legal doctrine called pure contributory negligence. This isn't just legal jargon. It's a brutal, unforgiving rule that you must understand. In almost every other state, if someone hits you and they are 90% at fault, but you were, say, 10% at fault for maybe going 1 mile over the speed limit, you can still recover 90% of your damages. It's a proportional system, but not here. In DC, if you are found to be even 1% at fault for the accident, you are barred from recovering a single penny from the other driver's insurance company. 1%. You could be stopped at a red light and get rear-ended, but if one of your brake lights was out, an aggressive insurance company could argue that you were 1% responsible. And just like that, you get nothing. Zero. This is why your actions at the scene are so critical. The first thing you do after ensuring everyone is safe is call 911. Always. Even for a minor fender bender. You need a police report. It creates an official third-party record of the incident. While the police don't determine legal fault, their report is a powerful piece of evidence. Second, become a documentarian. Use your phone. Take pictures of everything. The position of the cars. The damage to both vehicles from every angle, close up and wide. The license plates. The street signs, the traffic lights, the weather conditions, any skid marks on the road. Take a video, walk around the scene, and narrate what you see. This is your evidence locker. When you exchange information with the other driver, be polite, but be concise. Get their name, address, phone number, their insurance company, and their policy number. Give them the same information. And that's it. Do not discuss the accident. Do not apologize. Do not say, "I didn't see you." Do not debate who was at fault. Simply state the facts. We need to exchange information for our insurance companies. Anything you say can and will be used against you to assign that fatal 1% of blame. Now you're back home, the adrenaline is wearing off, and the reality is setting in. You have to make the call. You call your own insurance company to report the claim. This is your next critical test. When you speak to the claims adjuster, remember their primary role. They may sound friendly, they may sound concerned, but their job is to protect their company's financial interests. They are trained to minimize payouts. When they ask you to describe what happened, stick to the objective, verifiable facts. Do not offer opinions, do not speculate, do not guess. If you don't know the answer to a question, say, "I don't know," or, "I'll have to check my notes." They will likely ask to record your statement. You have the right to say no, or to say you'd like to prepare first. A recorded statement is a formal piece of evidence. If you're flustered and misspeak, they will use it. For example, if they ask, "How fast were you going?" and you say, maybe 30-35, they will note that you were uncertain and potentially speeding. A better answer is, "I was traveling with the flow of traffic and at the posted speed limit." Be precise. Be factual. Be firm. The insurance company will then begin its investigation. They'll review the police report, your statement, the other driver's statement, and the photos. They'll assign an appraiser to inspect the damage to your car. Here's another key DC protection. You have the right to have your vehicle repaired at the shop of your choice. The insurer might have a network of preferred shops and they'll push you to use them, often because those shops give the insurance company a discount. But you are not required to use them. If you have a trusted mechanic or a high-quality body shop you want to use, insist on it. Get your own independent estimate to compare with the insurance company's offer. Sometimes the cost to repair your vehicle is more than its determined value. This is when the insurance company will declare it a total loss. They will offer you a settlement for the actual cash value, or ACV, of your car. This is another area for negotiation. Their first offer is almost never their best offer. They use valuation services that can often undervalue your vehicle. Do your own research. Look up comparable vehicles for sale in the DC area on sites like AutoTrader or Kelley Blue Book. If your car had new tires, a new engine, or any recent major upgrades, provide receipts. You need to build a case for why your car was worth more than their initial lowball offer. What if you were injured? This is where DC's personal injury protection, or PIP, comes into play. As we discussed, this is mandatory coverage that pays for your medical bills and lost wages up to your policy limit, regardless of who was at fault. This is your first line of defense. You file a PIP claim with your own insurer. However, there's a catch. In DC, if you accept PIP benefits, you generally cannot sue the at-fault driver for your injuries unless those injuries are severe, permanent, or result in substantial disfigurement. This is a massive decision. If you have a serious injury, you may be giving up the right to be compensated for pain and suffering by taking that initial PIP payment. This is the point where you must seriously consider consulting with a personal injury attorney. Navigating this choice alone, against a team of experienced insurance company lawyers, is a battle you are not equipped to win. So let's say you've navigated the process. You've negotiated a fair settlement for your vehicle, your medical bills are being handled, and the claim is closed. You breathe a sigh of relief. But it's not over. The final blow often comes 6 months later, at your policy renewal. A massive rate hike. An at-fault accident is one of the biggest drivers of premium increases, and it can stay on your record for 3 to 5 years. This is where all our previous work comes full circle. This is when you take your clean driving record, your good credit, your bundled policies, and you shop around again. You don't have to accept the rate hike as a life sentence. Get quotes from Geico, from Erie, from Progressive, from all the top carriers in the district. Loyalty to an insurance company that just jacked up your rates is a one-way street. Look, navigating the world of auto insurance in Washington, D.C. is like driving in the city itself. It's complex, it can be aggressive, and one wrong turn can lead to a world of trouble. But it is not impossible. From understanding the mandatory coverages like PIP and uninsured motorist protection, to leveraging every possible discount, to knowing the brutal reality of contributory negligence and how to act at the scene of an accident, you now have the roadmap. You have the knowledge to transform yourself from a passive consumer into an empowered driver. You can take control of one of the most significant expenses in your budget, and more importantly, protect yourself and your family from financial disaster. This isn't just about saving a few $100s. It's about securing your peace of mind on the chaotic streets of our nation's capital. Drive safe, stay informed, and never stop advocating for yourself.